Howdy, Jacob here. Today we're looking at Chipotle Mexican Grill. Let's get to some of the financials here. $70.7 billion market cap, just under 70 billion enterprise value. I feel like people have heard of this company, so I don't really think I gotta do a description of it. So we can see that revenue has been very substantial outside of 2016, but growth, the year-over-year growth lowest year-over-year revenue growth is 7.1% and as high as 27.8% in the last 10 years. Pretty substantial. Their earnings per share, their gross margin's actually down a little bit. Operating margin's actually down a little bit from 10 years ago, but looks like there might have been some change between 2015 and 2016. Let's see if the cash flow statement has that. It does not. Well, I guess you can see some sell-offs of investments here. So that might be part of it. Let's see, 2016. Yeah, nothing super obvious that's showing why margins were hit so much between 2015 and 2016, but we are looking like they're getting back to what they were 10 years ago, and they're getting back with over double the revenue. So very positive growth there. Return on invested capital, 19%, most recent year. What's great about businesses that can just create stores is that if you put a store down on average, at least historically, they could be getting a 19% return, meaning that in a little over 4 years, you're getting your money back on that investment, which is very substantial. But obviously, with stores and restaurants and stuff, it's also very important to have same growth, same store sales. And so that's going to be a really important metric to look at if you're looking further in depth at Chipotle. You're going to want to make sure that their same stores are growing, and then also to exponentiate that growth, you're also having growth of stores that are hopefully efficient and good for the business and such. But pretty good return on invested capital, 19%. That's pretty substantial. Last year, 15.7%. So pretty good return on invested capital. Everyone loves the getting a Chipotle bowl and such. I think it's a little expensive personally, but whatever. Teach their own. Their use of capital has been really on investments, reinvesting back in themselves and buying back shares. I think that's great. I think for a company that has a great return on invested capital, it makes sense to buy back shares that are hopefully stupid cheap and then reinvest back in yourself. Again, whether these are stupidly cheap shares they're buying, different story. As for the balance sheet, no long-term debt, no short-term debt, 561 million cash, 735 short-term investments, so about 1.3 billion very liquid assets. They just have capital leases, which isn't really a concern for me, at least at these levels. And so I think I'm ready to start making some assumptions here. I will say that revenue growth, let's say that same stores grow a little bit above inflation, 3-4%, and then maybe they, increase stores 3 to 4%. I think 8% is honestly pretty reasonable. I will say this 8% growth. Let's see, what do I want PE, price for cash flow, to be? I think 18 is probably fine. I think that at the end of 7 years, they'll probably still have growth beyond inflation at that point. But I think it's going to be tough to really throw down as many stores as possible without hurting efficiency. And so that's my reasoning there. As for margins, it's been super high recently. Do I think that can stay? Just because I want to do research sooner rather than later on these great companies, maybe I'll do 10, 11%, and then say that they buy back 0.5% a year. Damn, it just looks kind of expensive to me. I don't know. I'm saying that their growth is 8% because they're reinvesting a lot of the money. Maybe let's say 1.5% of shares they buy back. That would be at about 1.4 billion. Oh, that's too much. Let's do 1. So they buy back about with about $700 million. That's more reasonable. And then they reinvest the rest. Okay. So here is saying that they buy back 1% of shares with their free cash flow. They reinvest back in themselves to really push an 8% growth rate on revenue. Otherwise, I think margins are pretty safe here. I just personally think it's extraordinarily expensive at this price point. I mean, again, I can see how people think that a terminal P, might be higher in 18. But for me, being as conservative as I am as a value investor, I'm not into making frothy assumptions and hoping for the best. I'm looking to make reasonable assumptions that I think have a higher probability of occurring. And I think if you're rooting for a 30 PE here, it's absolutely possible. I will not say it's not, but to me, with the type of growth they have and the type of company it is, they still have a bit of debt with their capital leases and such. I don't think the growth is there. I don't think they're going to be growing at 13, 14% a year, which will make up for their deflation of price to earnings and price to free cash flow. So hopefully everyone enjoyed the video and has a good rest of the day.